Good morning from London. I'm Kriti Gupta alongside Valerie, Tytel, and Oliver Crook. We're an hour away from the opening trade. Here's what you need to know. President Trump says he's chosen Stephen Miran to serve in Fed Governor Andrea Kugler's seat until it expires in January, in a move that investors say is one step closer to easier monetary policy. And the U.S. has put tariffs on imports of 1 kilogram gold bars, according to the FT, threatening more turmoil in the global gold market and dealing an additional economic blow to Switzerland's metals hub. Plus, President Trump says he's willing to meet with Vladimir Putin even without the leader of Ukraine, signaling a willingness to grant the Kremlin's request for a one-on-one meeting, despite threats of additional sanctions and penalties on the country. Val.
Good morning. We're just an hour away from that opening trade, and Euro Stoxx 50 futures have erased their earlier gains. But no, European stocks have outperformed this week, outperformed their U.S. peers based on this optimism around this proposed talks between the U.S. president and Russian President Vladimir Putin. Eurodollar is a bit stronger on the week, up 0.5%, but we are trading just shy of 116.50 to start the day. U.S. 10-year yields are hovering at 4.25, the highs of the week, but fixed income, it hasn't done very much this week other than rebound slightly from Friday's rally. The countdown to the opening trade starts right now.
It is, of course, Friday. It's light volume. It's light liquidity. Is anyone paying attention? Well, let me tell you, Donald Trump absolutely is, especially when it comes to the Fed chair. We've got geopolitics to talk about. We've got monetary policy to talk about, and a little bit about maybe what we learned throughout this week when it comes to the earnings picture. But we got to start with the top story here this morning, Val, and that, of course, is the fact that Stephen Miran is going to at least hold temporarily the seat of Andrea Kugler pending that Senate approval.
Pending the Senate approval, which could come ideally as soon as the September meeting, but most likely not. So the first voting meeting he'll be sitting at will likely be mid-October. He is known as a dove. He is one that believes, like Governor Chris Waller, that tariffs do not cause inflation. He thinks Trump's policies are net more deflationary in nature and thinks that the Fed should be cutting. There are some other very interesting things about him. He has been, of course, the backbone of the tariff policy, but was one of the really big proponents of this Mar-a-Lago Accord, this thought that the U.S. needs to weaken the U.S. dollar in order to help this manufacturing renaissance. There is also one very interesting topic I want to touch on from Stephen Miran, is that he essentially has made some pretty strong calls for Fed reform. He wrote a paper, co-authored a paper back last year at the Manhattan Institute, basically claiming that he wants a less powerful Fed. He wants them less involved in banking regulation, less involved in crisis response, and essentially wants a narrower focus for the Fed just on monetary policy.
And what I think is very interesting about this, of course, this is not just an addition of a dove, as you point out, but this really flies in the face of kind of all of the orthodoxy we've seen around monetary policy, how central banks are used post-financial crisis. A lot of governments have been able to step back from economic craftsmanship, just relying on super low rates for a very, very long time. Now we're having a different perspective on things. And by the way, this is basically the Trump playbook across the board. This is coming for central banking, but we've seen it in geopolitics, and we've seen it on tariffs.
Well, the fact that the consensus was for such a long time, let's wait, let's see what the tariff agenda is. You are now seeing actually a little bit of action here, and I think Mary Daly's comments in the last 24 hours or so were really interesting, who doesn't usually come out and say things like that, but she said you can't wait and see anymore. You have to act regardless of what the volatility is, because that uncertainty is here to stay, and that's something we're seeing on the tariff front as well. Specifically, again, a new day, a new hit to Switzerland, it seems, at least this week, at least through the metals market. And I thought this was a very interesting story, initially reported by our colleagues over at the FT as well. They're talking about the United States putting tariffs on imports of 1 kilogram gold bars. Now, ordinarily on the surface, that doesn't seem like it's that juicy, but it does, of course, hit the Swiss metals hub, and that is on top of already dealing with 39% tariff, not to mention being labeled as a currency manipulator.
Yeah, we haven't had much of a response from the Swiss government. They held an extraordinary meeting yesterday where it was said that they did consider retaliation in the way of canceling an order of F-35 jets from Lockheed Martin, but the president rejected calls to do so. So it does not seem there has been a big, at least, response, a holistic response from the government. But at least when it comes to market response, I think we also have to talk about what's happened with Japan. They have clarified in some ways, or they have said that the U.S. has clarified the fact that these Japan car tariffs do not stack. We see the Nikkei solidly in the green in the overnight session, and a lot of these automakers also given a boost by that clarity that these car tariffs will not stack and they will be lowered sooner rather than later.
And I think just thinking about what we got throughout this whole week, there were a ton of questions coming into this week about tariffs, a lot of things we didn't know. Let's just, for the audience here and for ourselves, kind of recap what we have learned this week. We've learned that the tariffs do not stack in Japan. We've learned that Switzerland is not going to get another deal. India, 50%. We've learned about the sectoral chips, 100%. And we've learned about the theory behind the pharma tariffs, right, which is going to be very progressive at first, 150% in a year, 250% thereafter. And that is going to be kind of more of the thinking fleshed out for the Trump administration. The other big question, though, is going to be sanctions on Russia. That was the big deadline. That is today. And we have seen some developments on that story, in particularly the fact that now we went from bone-crushing sanctions tomorrow to potentially a meeting between Donald Trump and Vladimir Putin next week. Could it involve Zelensky? We do not know for sure. We know that the location has been decided. We do not know where that location is. These are going to be a lot of the questions going forward. But again, I think there is a lot of sort of, skepticism that anything substantial could happen here, but they are talking very openly with conviction that there is going to be a meeting between President Trump and President Putin.
And this is a meeting that the Kremlin has been asking for quite some time. We know that Steve Witkoff was just there in Moscow as well, a meeting that he called very productive, perhaps kind of lay some of the groundwork for this meeting between Donald Trump and Vladimir Putin. I think what's fascinating, though, is this is also coming, to your point, just a complete 180 when it comes to the pressure being added to Russia, how much of the pressure that we've seen on India and arguably China as well in terms of those oil sanctions and kind of the penalty for buying that cheap oil is actually bringing the Kremlin to the table. That's up for debate.
And also the reaction in the oil market has been, I think, pretty one way this week. Yes, it did rally somewhat on this threat of secondary sanctions, but over the week we have Brent, we have WTI down around 5%. So I think it's more reacting to the hopes of this ceasefire, the fact that we get a lower oil price, just less tensions in the world. We also saw a big reaction when it came to European equities. We had European stocks outperform yesterday, but defense underperformed.
Absolutely. I mean, we saw it across the board. Rheinmetall was a little idiosyncratic because we had earnings, but down about 7% at the close yesterday. But BAE was down, one of the biggest losers. Rank makes the transmissions for tanks, one of the biggest losers. All of that being said, potentially some of this sort of rally coming out of the defense on potentially progress on Ukraine, Russia. We should say that the other sort of major global conflict in Gaza and Israel going in the opposite direction. We do not have clarity on what's going to happen in Russia, Ukraine. It is clear that the Israeli situation is going to get a lot more involved, according to the Israeli government.
And we'll bring updates throughout the show about both of those conflicts. In the meantime, let's tell you who we've got joining the program this morning. Kriti Gupta, Wisdom Tree's macroeconomic research director, will join in just a few minutes. Plus, the take from Beata Manthey, Citigroup's European equity strategy head, as well as Ollie was mentioning, are geopolitics, or at least the resolving of conflict, a bad thing for European investors? It's almost counterintuitive when just 2 years ago it was the opposite narrative. Tom Keating over at RUSI, Center for Financial Security, the director there, will be joining us as well for his take on the geopolitics. And then, of course, the conversation on Swiss tariffs. Jan Adeslander, head of international relations at Swiss Economy Swiss, is what I'm going to try to say. This organization is going to be joining the program as well.
So that'll be the guest later today. Later today, we're going to be watching for the markets. The BOE chief economist Hugh Pill will be speaking at the National MPC agency briefing after a finally balanced decision from the BOE yesterday. So clearly going to be watched very closely. Canadian employment report will be a little bit later in the afternoon, 1:30 UK time. And then also hearing from a number of different Fed speakers. And of course, for Val Tytel on Saturday, PPI, CPI out of China, followed and also by Fed Governor Bowman speaking a little bit later.
Yeah, highlight of everybody's weekend. We get to hear from the dissenter herself. She did write a dissenting opinion, but that was released before those payroll revisions that we saw last Saturday. So I'll be very interested to see whether tomorrow she just amps up this language around worries about the labor market. Now that we have potentially this Stephen Miran joining the Fed governors, there could be potentially 3 dissents at the September meeting if the committee as a whole decides not to lower interest rates, and that could be a big blow to Chair Powell's hold over the FOMC.
Yeah, it's fascinating how quickly the narrative has changed and how quickly the ripple effects are going to show up, because it kind of feels like the idea that the market is now pricing in cuts more substantially. I mean, a month ago, we were saying that was crazy that the markets are overthinking it, and it's kind of come to fruition to some extent.
And so as we fill some of the unknowns in some of the agenda, some of the positions, it's actually creating a greater array of other unknowns, as you're pointing out here.
Yeah, exactly. Here's what else you need to know this morning. Let's talk about Israel's Prime Minister Benjamin Netanyahu has secured cabinet approval for a military takeover of Gaza City, which he described as being part of a final push to topple Hamas after 22 months of fighting. The decision to step up operations marks an escalation in a conflict that's already devastated Palestinian territory, where the UN food program has warned 500,000 people are starving. Brazil says that Indian Prime Minister Narendra Modi talked trade with his Brazilian counterpart and is expected to head to China for the first time in 7 years this August, against the backdrop of worsening ties with the U.S. Discussion focused on the imposition of unilateral tariffs against their nations, with the two leaders reiterating plans to strengthen trade ties in their call yesterday that lasted nearly an hour. And finally, French winemakers have seen extensive damage to vines that were almost already ready to be harvested after the worst fires in more than 70 years burned through the south of France. There hasn't been a preliminary assessment of losses yet, but a large number of vineyards have been destroyed, along with equipment and buildings. The fires come just 10 days before the harvest was set to begin in the region.
Certainly a tragedy that has economic and market consequences. We'll watch that story very closely. Coming up on the program, Meta picks PIMCO and Blue Owl Capital to lead financing on its new $29 billion data center expansion. More on the big money piling into the race for AI infrastructure throughout the program. Plus, President Trump escalating his attacks on wind and solar power, threatening future development. We're going to check in on the biggest European players in the space. Up next, though, a focus right back on the Fed as the leadership gets the spotlight. Donald Trump to nominate Stephen Miran as governor, while Chris Waller emerges as the top pick for central bank chair. We're going to dive into those market ramifications. If you have any questions for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
I think that Governor Waller has really built up a really impressive track record, not succumbing to the tariff derangement syndrome that many others throughout the country, but particularly at the Fed, seem to have succumbed to. And he's done a really good job having an independent voice, which I think ultimately is proving correct.
A new derangement syndrome there from Stephen Miran on Bloomberg yesterday. Tariff derangement syndrome. Speaking about Christopher Waller before his Fed nomination, Val has much more on this sort of new two appointments here potentially coming through and their implications. Val.
Well, what they both share is they are both very critical of this idea that tariff cause inflation. Stephen Miran is actually of the idea that if you take Trump's policies holistically, they are deflationary in nature. So there is, I guess, no doubt on the market's mind that he will be a dovish voter on the Fed governor sheet after he gets confirmed by the Senate. There are some interesting things, though, about Stephen Miran. He has been a longtime economic ally of President Trump, has worked with him on this tariff policy, but he also co-authored a quite interesting paper last year at the Manhattan Institute calling for Fed reform, calling for a restructure of how the Fed works, essentially wanting the Fed to have more oversight and less power. So this pick, guys, could be seen as, yes, a dovish pick, but also maybe a hint that Trump wants more restructuring happening at the Federal Reserve. In this paper, Stephen Miran argued that the Fed should have a narrower focus only on monetary policy, and it should be limited when it comes to crisis response and limited when it comes to how much they're involved in banking regulation. So he is one for a smaller, less powerful Federal Reserve. All in all, this has continued the pressure on the U.S. dollar, this dovish Fed chair pick when it comes to the talk about Waller and the talk about Kevin Miran. So we are on a 6-day losing streak for the Bloomberg Dollar Spot Index. It's longest since April and has now taken 1.5% off the index this week. Kriti.
Yeah, it's a fascinating one. The market's bracing for impact, or maybe they've been bracing for impact all along. Joining us now, Anika Gupta, Macroeconomic Research Director at Wisdom Tree, joins the program from further analysis. Anika, just walk us through maybe the dynamic that Val was talking about here. Stephen Miran in this chair, potentially Chris Waller becoming Fed chair. Is this something the markets need to be concerned about or need to price in or need to act on? Your take.
Yes, for sure, Kriti. I think it does take on a more dovish tone for the Fed. So far, under Fed Governor Jay Powell, we have seen a more restrictive take on monetary policy. He's been extremely cautious on the threat of tariffs and how it's going to feed in to higher inflation. So now with with these new candidates in place, there is a much more dovish tone being priced in, and hence, as Valerie was saying, that really takes us to a much weaker dollar and does put in that, further weakness and an emphasis on weaker growth in the U.S. that we do need to focus on.
But Anika, there has been a narrative baked into this market that the economic resilience, although not at a run or at an expansionary phase, does still very much exist. How much of a dislocation is adding a cut? The folks who are eyeing inflationary tariff pressures, let me rephrase that, inflationary pressures from tariffs, would argue that this is still a moment too soon to take that step.
That's correct. I mean, right now, I think the odds are tilted towards emphasizing on the labor market and keeping that emphasis on growth in the U.S., as opposed to how quickly and how sharply inflation is likely to turn. And we have seen signs of that last week with some deterioration in the labor market, providing that reason and that urgency to go ahead with the rate cut, which is why we're seeing, that pricing change at such a fast pace. And I think that remains the key focus for U.S. markets. The Fed has been extremely cautious so far, but given how the data is beginning to change, it does warrant a second look and, a rate cut to take place in September.
So we've had action from the Fed, we've had action on tariffs, we also had action from earnings season. For you, what are going to be sort of the main drivers here between those three? And within the earnings season, if that is going to be in the short term kind of what animates the markets, what have you seen this week that's changed your perspective?
Well, one thing that's clear is we're seeing headline indices stand at new highs. Clearly, the S&P 500 has roared back, with strength, but that leadership is worryingly narrow. We're seeing, clearly the mega cap 5 stocks in the U.S. are dominating. Even when it comes to the concentration in the market, it remains very high, close to about 22%. If you compare that with Europe, in Europe, we have seen a slightly weaker earnings season with financials really dominating, the recent strength within the European earnings season. If you really strip out the financials, the earnings season for Europe has been quite lackluster. If we think of, 3 key sectors that have stood out during Q2, it's really been aerospace and defense alongside financials that have, really kept up that momentum for Europe. So I think there is, while we've started the year with, European bourses leading on performance, now as we turn to Q2 and we start to get a bit more clarity, we are seeing narrowness in the market, but alongside that, we are seeing dominance of US taking place over the European equity markets when it comes to earnings.
And I'd like also to get your interpretation from a sort of macroeconomic perspective, the impact it could have on the markets, but also sort of on the economy here in Europe, of the significance of this meeting potentially between Putin and Trump next week. If you ask the oil market, you've seen oil sell off, to the tune of about 5% over the last week. Maybe that's just in terms of a little bit of caution. I think there is some sort of subdued expectation here. But if you were to see a meaningful step forward in those discussions, what is the implication?
Well, we've been here before. We have had this meeting between President Trump and Putin. We've had a conversation, a telephone conversation take place. We've had President Trump meet with President Zelensky, and very, very high hopes being placed into this meeting, following which we have not been able to obtain a ceasefire. In fact, if anything, over the past 2 quarters, we have seen an intensification of the Russia-Ukraine war. There are really 2 scenarios that are likely to play out. And even President Trump said it himself, he doesn't know whether it's going to be successful or not. And so those 2 scenarios are, if we do get this ceasefire taking place, if we see a dialing down in the geopolitical risks from the Russia-Ukraine front, then it's really, the tilt is towards looking at the Ukraine reconstruction basket, how these industrial companies, the construction companies that are, have these long-term contracts being placed there, are likely to benefit. We've already seen a few Russian companies also, begin to. We've seen Raiffeisen Bank also, bring back that strength. Now, scenario 2 is we're back to square one. None of the three parties agree to come to a conclusion, and hence, it brings back that story of European aerospace and defense, where the European defense contractors continue to try to meet these climbing order backlogs and try to fulfill those order backlogs with this increased demand that they're receiving. And then it's very much a growth narrative story for the European market.
Anika, I want to take this a bit more macro for a second. We've seen the U.S. dollar, obviously it started the year very much on a back foot, and it seems to have resumed its decline since that weak payroll number on Friday. What's your view on the U.S. dollar, given you seem a bit more positive on U.S. equities? Do we think this reallocation trade has run out of steam here?
Well, I mean, the weak U.S. dollar is clearly filtering in the earnings season. The weakness of the dollar has been one of the biggest beneficiaries for U.S. Mega cap stocks, owing to the translation effects. In our view, the U.S. dollar is likely to weaken, owing to concerns of the rising, the large fiscal deficit that the U.S. has, which continues to increase. At the same time, we are seeing, a narrative for growth beginning to weaken in the U.S. amidst a weakening labor market, and hence that just puts forward the case for the dollar to weaken. And at the same time, Europe is also gaining a lot more strength in comparison, and hence that just changes the narrative where we are setting the stage for a weaker dollar, and at the same time we are seeing other currencies, especially in EM, rise in comparison to the US dollar.
Anika, that's exactly where I wanted to go next. If we are seeing a weaker dollar alongside the U.S. economy slowing down, is there really that much room for EM to outperform if the world's growth engine, being the U.S. consumer, starts to turn?
Absolutely. So far, emerging markets have come back with a very strong performance, and it's very much being predicated on the weaker dollar. Now, there is a little bit of a bifurcation taking place within emerging markets, where we are seeing a lot more strength in some of the Asian countries, such as South Korea, Taiwan, that are really leading and showing that dominance within the technology sector. Now, India at this point in time is coming under a lot of pressure from President Trump, with those tariffs being raised from 25%. They could now face an additional 25%. And this is really owing to the fact that India is buying record amounts of oil from Russia. But it's important to keep in mind that China is buying actually more oil from Russia. But China is actually facing much less pressure from President Trump, because they have that key bargaining chip, which is rare earth elements. So with China dominating the market on rare earths with more than 90% processing facility, they really are dominating when it comes to those trade negotiations between President Trump and President Xi in China. So we are seeing that bifurcation take place. We're seeing that growth dominance with Latin American and Asian countries, holding that mantle place for emerging markets, whereas we're seeing a bit more pressure come through for the Indian economy.
It's certainly interesting to see how not only the China negotiations play out, but the ones with Mexico as well. Anika Gupta, Macroeconomic Research Director over at Wisdom Tree, with some analysis this morning. We thank you so much. Coming up, a focus on Switzerland as hit with 39% tariffs. We're going to talk to the head of the Swiss Business Federation. This is Bloomberg. Thirty minutes from the start of the opening trade, it kind of seems like futures are on a little bit of autopilot. Green on the screen across the board, even in Switzerland. And we're going to get to that story in just a moment. Eurostoxx 50 futures higher by 0.2%. The outperformer from the futures picture, at least, looks like is over in France. The CAC 40 higher by 0.3%. The FTSE 100 higher by 0.2% as well. Not shown on the board, though, but worth mentioning is the fact that DAX futures are flat. And this is a conversation we're going to have throughout the rest of the show, which is really this idea of how much of that kind of defense momentum that faded from yesterday's session is ultimately driving, or going to be driving, what's going on in the DAX for not just today's session, but going into the next few weeks and months as well, Val.
Let's turn to fixed income, check in how these European bonds are faring. We are continuing to see yields just creep slightly higher. It's kind of been the theme of this week that we've been retracing that rally from Friday after the weak payroll number. Yeah, 1 basis point higher on the German 10-year yield. The other theme of this week has been the weak auctions out of the U.S. We had the weak bond auction last evening, and 2 days ago, weak 10-year auction. So it does seem to be like demand for yields at these levels. It's just not really there in the month of August, but perhaps due to return.
All right. Well, from the bond market to the tariff market, Tokyo's top negotiator says the U.S. has confirmed it will end stacking from universal tariffs on Japan and cut car levies as promised. For more, we're joined by Bloomberg's Jill Desis. Jill, how soon will this happen? Take us through the details here. Does this bring a little bit more light into some of the ambiguity we've had on this tariff conversation?
Yeah, I mean, I think at this point, what's important to remember is that we've heard from the Japanese side of things. So, we still need to hear kind of from the U.S. side, and also point out that a lot of this has been discussed verbally, and we still don't really have like a, true like white paper kind of official documentation for how exactly some of these tariffs, will work, which may be, sort of the source of some of this confusion. But what Akazawa, the lead Japanese negotiator, is saying is that coming out of these meetings, there has been that agreement that they had these stacked tariffs that shouldn't have been stacked, that the vast majority of these tariffs should really apply this 15% tariff levy, which is what the Japan and the U.S. had agreed to ahead of the initial tariff deadline here, and that. Also, it seems like there's going to be some adjustments potentially to the autos tariffs as well. That was another one that it seemed, there came out some kind of a misunderstanding where the Japanese automakers were tariffed on much higher rates than this 15% that Japan had thought that it had agreed to. Again, I think we're still waiting to see what exactly that looks like. Akazawa has implied that maybe it's not going to be, a particularly long time, but I think it does point to the fact that these are really, really difficult to negotiate tariff arrangements. Trade agreements typically take years to essentially resolve. We're trying to get all of this, or the U.S. is trying to get all of this resolved in just a matter of months. So it does kind of show a lot of that trickiness when it comes to how a lot of these things, many of which have been agreed to verbally, we're still seeing how that all ultimately plays out on paper.
Jill, let's go from Japan to Switzerland. The FT reporting this morning that the U.S. has added tariffs on gold bars. Can you just connect the dots for us on how this impacts Switzerland and ultimately the trade talks with the states?
Yes, Kriti, I think, important to remember, so this is based off of a Financial Times report. The Financial Times is saying that they've seen this letter from the Customs and Border Protection Agency in the United States that does lay out this tariff on 1 kilogram gold bars. I think, at this stage in time, where that really enters that conversation about Switzerland is that Switzerland is still trying to negotiate down this incredibly high tariff, 39%. Incredibly high, particularly among industrialized nations, by the United States. And gold is a major export for Switzerland. So if you're looking at additional tariffs on top, potentially, again, it's based on this FT report looking at this particular tariff that the FT is reporting on. But if you're looking at additional tariffs alongside that 39% tariff rate, Switzerland has a lot of really key exports that, it certainly has concerns about gold, pharmaceuticals, that just kind of adds another wrench into that conversation. So far, obviously, Switzerland hasn't been particularly successful at trying to negotiate lower, but, it could be possible that things are open here. I really just want to stress that when it comes to Donald Trump, when it comes to the Trump administration and negotiating all of these different tariff rates, we obviously have many different numbers that are flying around here, many different sectors that are targeted, countries that are still trying to negotiate down tariff rates from, other highs. We do see a lot of this kind of deal making happening. It really does, I think, still imply a level of uncertainty when it comes to U.S. trade negotiations, even though we've already passed, a couple of really key deadlines that the Trump administration has laid out for when it wanted to get some of its important tariff rates set.
Well, Jill Desis in Hong Kong, thank you so much for your time this morning. And I think that really speaks to one of the great concerns here with the Trump administration and all of these trade negotiations is that no deal potentially is a final deal, even if it's difficult to even get to that deal. And joining us now is Jan Attenslander, who is the head of the international relations at the Économie Suisse, an umbrella organization for the Swiss business sector. Jan, thanks so much for speaking to us this morning. I mean, you have been in extreme contact with the sort of Swiss business community. I'd like to just begin with what they are saying and what their expectation is in terms of what we're going to see from the Trump administration in these negotiations with Switzerland.
Well, good morning, everybody. Last week, just 1 week ago, they were just shocked about the news that we are subject to 39%. This is unjustified for every one of us. You can't explain it. And now they are starting to cope with it and implementing it to do it the right way. And so we are now taking up the job.
And in terms of taking up that job, can you quantify what the impact is going to be on these businesses, on the economy? Is it something that is so vast that you can't get your arms around, or can you give us an idea of what the impact will be?
That's a good question. No one can tell you at the moment what the real impact will be. Some forecasts say it might be 0.3 point or 0.6 point GDP in total if that stays like this. Others say it will be even weaker. What is sure that there are thousands of jobs at risk because there are some companies that are highly focused on exporting to the US markets, and you just cut off trade with 39%. And at the same time, these companies are, of course, also in close contact with US customers, because it's US customers who have to pay these high import tariffs now on Swiss goods.
Jan, you've commented that a fair deal is better than cutting off trade. But in your mind, what does a fair deal look like for Switzerland?
A fair deal might be the one that was on the table. We had a draft declaration, a text, a final text, not a blah, blah, not statements, but a real text that was finalized early in July this year. And that could be the basis for the discussions that are going on now in Washington or wherever you can meet now these US officials. That's one thing. And the fair deal is then, of course, something that reflects the structure of our economic relations. Switzerland is the sixth largest direct investor in manufacturing and services in the United States, creating thousands of jobs. We talk about 400,000 jobs. So if you take this into account as well, we are not an unfriendly partner. We are a strategic partner of US economy. And there's no reason to give friendly fire on such a partner like Switzerland.
Jan, one of those key trading relationships does include the export of pharmaceuticals from Switzerland into the U.S. In your mind, do pharma tariffs have any place in a fair deal for Switzerland?
I can't tell you right now, but we must consider these are life-saving drugs, for example, in cancer treatment, and they are absolutely contributing to the national health system and the stability in the United States. So we don't take anything away. And these are, by the way, the companies that invest most from all foreign companies in research and development in the United States. They're the Swiss companies are #1 investors in the United States. So it is possible that some pharma tariffs might be part of a declaration. On the other hand, that's not the way how you reduce prices for pharmaceutical products in the US market.
Jan, talk us through the backup plan here, the doomsday scenario. If there isn't some sort of trade deal reached, if these investment promises ultimately don't garner the goodwill of Washington, how easy is it for Swiss businesses to pivot to other regions when it comes to their consumer base or even their supply chains?
Well, we must here be very clear. You can't substitute a market in the size like the US. It's the biggest market in the world. Many companies, on the other hand, will find solutions. They can set up production in the United States or even more likely in Europe or in other areas of the world. That's one possibility. Then other companies, they have highly specialized products and there is no substitute. And you just have to pay the tariff if you don't want to stop an assembly line or if you don't want to stop the production in a refinery. So in case by case, it will be quite different. Our exporting companies are very often highly specialized niche players, SMEs. They know one or two tricks, but they are the only one in the world who know these tricks and have built up long-standing relationship with US customers. So it's really difficult to say what the backup plan in general will be. And one thing is also to be noted quite clearly. The United States, as big as they are as a market, for us, they account for 17% of our total exports, meaning that 83% is rest of the world. And of course, Swiss companies now will also focus more on these 83% of total exports.
Jan, walk us through your conversations with the Swiss government specifically. There was news of an extraordinary meeting yesterday with Swiss government on how to proceed. Can you give us a little bit of insight of what that meeting might have entailed?
Well, I'm not in a position to talk what has been subject to these discussions. What I can say in general, we are in constant contact with the President of Switzerland, of course, with our Minister of the Economic Affairs, Guy Parmelin. We have well-established a working relationship with them. That's one thing. Also, some of our companies are in a constant dialogue if they have a concrete issue to be talked about. And so we are here in a rather small country in a situation where we get the information we need and we give the input that might be needed for clear-cut measures by our government. And this is going to continue also in the domestic package, how we address competitiveness in Switzerland. There are many things we can do without asking anyone, because that's domestic affairs and economic policy in Switzerland.
And economics policy in Switzerland has been described, I think, in many ways on trade, which is being close to Europe, but not too close, right? And that is something that potentially now Switzerland is a free economy, a free player around the world, is potentially coming into question. How do you think this new global paradigm should change Switzerland's relationship to its trading partners, and specifically its relationship to the EU? Should that adapt?
Well, we are already enjoying extraordinary good trading relations with free trade agreements with many partners all over the world. We just concluded a big deal with Mercosur. Another one that was concluded last year is with India. And of course, Europe is accounting for 50% of our total exports, the European Union. And here we are going to continue our bilateral way, how it is called, with many agreements. And we have now a big package on the table that will be subject to ratification procedure in Switzerland this year and the next year. And we are quite confident that, of course, this is going to continue. We have a strategy of diversification of our trade relations on a very high level with very good free trade agreements and fair deals with all our partners. So the United States development is clearly an outlier here when you compare it to all our other trading partners.
Jan, a final question to you on the gold prices specifically. We know that in the last 24 hours, at least there have been reports by other media organizations that are saying that there are now import tariffs when it comes to gold. And although it doesn't directly affect the Swiss economy, we know that the Swiss metals hub is certainly one that's in focus. Any thoughts on how that can be addressed?
Well, just look at these regulations. I got the same information yesterday that something has been to clarify, but I can just tell all the customers in the United States, make sure that you get it right. We saw a large drop of gold bullion exports to the United States already in May. Before that, it was billions, and then it dropped to a couple of millions. So we already have it in the system here, that something has changed on the tariff treatment of these gold imports to the United States. We must also know that Switzerland is a leading economy. We have some gold refineries, and you need these refineries to produce certified bullions for that market. So here you don't get that easy around a Swiss contribution in the gold value chain.
All right, Jan Adesländer, Head of International Relations over at Economy Suisse, Swiss Business Federation. We thank you so much for your insight on that. Look forward to having you again on the program. Coming up, we're going to shift our focus to some of the earnings story because they are still coming in hot and heavy. Munich Re cutting its insurance revenue guidance for the full year. We'll talk about that. Your other stocks to watch next. Stick with us. This is Bloomberg.
We're around 11 minutes from the opening trade here in Europe, and the futures picture is looking pretty positive for this August Friday. Eurostoxx 50 futures up 0.25%. We do have S&P 500 futures also in the green. One has been the theme of this week of rebounding from the slide from Friday's weak payrolls, and that's definitely continuing on this Friday. Joining us now to discuss more markets is our Morena Conium from our Markets Live team. Good morning, Morena.
Morning.
We haven't really talked about the Bank of England decision yet yesterday. An astounding 2 rounds of voting. This also coincides with a Banxico vote that was also a split vote. Seems like monetary policy is not clear on what to do here.
No, and I think uncertainty is one of the key words that we're hearing, all around at the moment. Bank of England yesterday, they really couldn't decide. It was a very, very finely tuned decision, as Andrew Bailey put it afterwards, with, you had quite a lot of the Monetary Policy Committee voting to keep rates on hold. They ended up, voting for that 25 basis point cut, which was what economists unanimously expected. But they did not expect the split that we saw. And they certainly didn't expect, I think, that sort of push towards holding rates, the concerns about inflation that were noted, throughout the press conference afterwards was really quite notable. They even had a separate box in their statement, about particularly food inflation. And that really is an area of inflation that impacts consumer sentiment. And so it can affect sort of future inflation expectations. So I think there was quite a lot of concern there. There was definitely a bit more of a hawkish tilt than we have seen. And so that actually means that you've got the markets reducing their bets on future cuts from the Bank of England, although they stuck to their guidance for a gradual and careful continuing sort of rate of monetary easing. It did sound a little bit more hawkish. We saw markets reducing their bets, and actually that's benefited the pound, and it sent lower end gilt yields higher yesterday as well.
Yeah, and I just want to talk a little bit about how that reads through to the market. A more sort of conflicted, shall we say, Bank of England going forward. What does that do for sterling? What does that do for stocks in the UK?
Well, yeah, as I said yesterday, the pound did rise. Yeah. This morning it's a little bit off, but we went back above 134 as the market pared back those rate cut expectations. But I think what's quite interesting, though, is you've got to remember that the pound, does trade inversely to the dollar, and we've got the opposite happening over with the Fed, with expectations now mounting that with the direction of the sort of personnel at the Fed, that we're going to see a more dovish tilt, that those rate cuts will keep sort of reignite. And so I think a lot of what happens to sterling will actually be determined by what happens to the dollar going forward. But in terms of, for sterling itself, I think it is a positive, and we could then see that it going higher still if particularly we get a weaker dollar story at the same time as we've got a slowing Bank of England.
Morena, we've got about 30 seconds on the clock. Talk to us about how much of expected rate cuts, whether it's the BOE, the Fed, or name your central bank, is actually a tailwind to the stock market that's dealing with volatility, it's dealing with uncertainty, and ultimately tariffs.
Yeah, well, it's very interesting, I think, for the FTSE 100, which I would like to say is still outperforming both the US and European stocks so far this year, because actually it is incredibly internationally focused. So it doesn't like a strong pound. But equally, a lot of them also earn their revenue in dollars now. So actually, I think it depends. You might see the mix shift, but that higher sterling isn't necessarily a good thing for the FTSE 100 unless it's tariff-driven.
Yeah, a tricky one as well. We'll see how it all unfolds. Morena Conium from our Markets Live team walking us through those dynamics, the transatlantic dynamics, I should say. We thank you so much. Let's go from the macro to the micro. Get our stocks to watch with Louise Moon. Louise.
Good morning, Kriti. The first one we're really focusing on this morning as markets will open is GSK, the pharma giant in the UK. As you see, they've had a bit of a tepid year so far, not many gains. There's some positive news out this morning. They've won a patent dispute that has been ongoing for years. They're set to receive almost $400 million as a result of that, and then royalties on their COVID jabs sold in the US going forward. So you'd expect that to be a bit of a boost for the stock this morning, so we'll have to wait and see how that plays out, if it adds to any gains so far this year. The next one we're looking at is Munich Re, the German insurer. As you can see, a strong year to date so far, up almost 25%. They had their first half results this morning. A bit of negative news there. They cut some of their full-year guidance, not all of it, but a key metric they cut, so you'd expect that to potentially weigh Germany on the stock this morning, so we'll be watching that one closely. And then finally, sticking with Germany, Rheinmetall. Obviously, we had their full-year results yesterday. The stock plunged as a result. You can see just at the end here, down about 7% yesterday. There is a bit of positive news, however, that could boost the stock back up again this morning. You can see their buy ratings. There's 18 buys now on that stock. BNP Paribas actually initiated their ratings. They put them at an outperform. And there was a really positive note from BI this morning saying the outlook still looks bright. They're going to capitalise on Europe's defence recapitalisation. So that could potentially raise their stock back up again this morning and continue on their winning streak.
We look forward to seeing whether they can recoup yesterday's losses. Equities reporter Luis Moon walking us through some of those stocks to watch this morning. We keep coming back to this defense conversation because, of course, it was so baked into these markets. It's so core to the European bull case. And yet, maybe not this time.
Well, it seems like a lot of the underperformers, a big underperformer yesterday was all these defense stocks. I mean, Rheinmetall, one of the worst performing stocks yesterday in the Eurostoxx 600, down around 8%. And it seemed to drag the whole sector with it. Whether that was related to earnings or to the U.S.-Russia talks, I guess it remains to be seen.
Yeah, I mean, I also think it's quite aggressive, though, still to have a sell rating. I'm just looking up who that is on a Rheinmetall. It's Alpha Value, still wanting to sell the stock, I think is a brave thing to do into the world that we live in.
A brave thing to do, indeed. I mean, it's a fascinating one, though, if we continue to see it become more of a vehicle of volatility as opposed to an actual bull case. More coming up on the opening trade. Futures in the green. This is Bloomberg. A few minutes to go until the opening trade. It's kind of interesting. We think to understand today's price action, you have to understand what happened in the last 24 hours. Now, this is not a complete chart of what we've seen in the last 24 hours, but it's important to know where we ended. I think that's what this chart does best, and that you're seeing that Stock 600 and the S&P 500 closed ultimately in the red. The S&P 500 marginally in the green, but again, not enough to really highlight the value, the momentum that we've seen in both sides of the Atlantic in the last couple of days. But it's that backdrop that might set us up for the futures picture, Val.
Futures picture is looking positive. Has been quite a positive week for European equities, outperforming the U.S., and that's continuing that narrative today. Eurostoxx 50 futures in the green, up 0.1%. FTSE 100 futures up by a similar amount. The DAX, however, is unchanged. Is this the defense story taking a back seat? We have a few minutes to see if that sticks. But Ollie, are defense stocks on our radar this morning?
Yeah, they'll be on our on our radar this morning. They always are. But I think that after that sell-off yesterday, we'll see what the market makes of these conversations between Trump and Putin as they emerge throughout the day. But also we'll be watching GSK a little bit later when we get the open here. They're going to get $370 million up front in royalties on mRNA vaccines following a settlement in the United States, called up ever so slightly there. Then also the insurers, Munich Re, they're a little bit lower on Tradegate this morning. They've cut some of their guidance, still fairly modest, called down 1% to 2%. And then Travel and Leisure, the other one we're watching. We spoke to IHG Group yesterday, extremely bullish. That stock was up 6%. That also follows what we got from Expedia and TripAdvisor over in the United States. So we'll be watching those closely. Travel and Leisure, the second best performer yesterday, up almost 2%, Kriti.
The airline space, the insurance space, the healthcare space, all very much in focus, but is ultimately the regions that take the precedence. We're looking at the DAX, we're looking at the SMI this morning as we digest all the geopolitical headlines there as well. And here it is, the opening trade as promised. The FTSE 100 kind of still waiting to shake out just a little bit. We are flat on the session, but again, give it a second. It's been about 10 seconds. The IBEX right out of the gates, actually efficient this morning, higher by about 0.2%. Starting to see a little bit of a marginally green shift. And I think marginal is the key term there. And that's kind of what we saw in the futures picture as well that Valerie has set us up for nicely just a few minutes ago. The FTSE 100 now the outperformer, higher by about 0.3%. But look, I think the juicy bit that we're waiting for in this market is ultimately the DAX and the SMI, the unwind, I should say, of some of those defense names that have been powering that market higher. We'll see if that actually sticks this morning, Val.
Let's take a look at how these sectors are performing so far just at the open. We are seeing the healthcare sector at the top of the basket, up 0.7%. That is led mostly by Novo Nordisk, up 2.5%, but also GSK in the green. I know Ollie was just talking about their settlement case, so that boosting the GSK stock as well. When we take a look at the losers when it comes to the sectors, we do have energy at the bottom of the basket. No surprise there. Oil has been surprisingly weak this week, down around 5% on Brent. Travel and leisure also at the bottom there. there. We know we just talked about some airline weakness there. Insurance also near the bottom. Maybe that story is related to Munich Re. If I see that stock pop up, I will bring that to your attention. But a bit mixed when it comes to the sectors. But overall, still a day with 361 stocks opening up in the green and only 133 in the red.
Yeah, Valerie, interesting watching the healthcare sector. I mean, that Novo getting a further rally from yesterday, and that was after Eli Lilly lost almost a tenth of its value yesterday after its weight loss drug did not pass a certain study there, and that made a huge gains for Novo Nordisk. I guess that's happening, continuing into today. And GSK now, as we were just mentioning, watching ahead of the open, up 1.34%. That is getting some royalties from some of that mRNA drugs that they've got out on the market there. So getting a little bit of a boost there, and also it seems Novo Nordisk there, the big winner today, up 2% after gaining massively yesterday.
We still see some pain in the healthcare sector broadly, or maybe a little bit of a rebound. It's a bit of a mixed picture there. I think what's interesting, though, is when you're looking at some of the commodity names as well, it's worth mentioning a little bit on the back foot today. And I'm curious how much of that simply is a reflection of the oil price that we are seeing. BP, for example, down by 0.6%, as we see Brent continuing to tick lower, Val. And
I know we did mention the defense story. Defense stocks were very much on a back foot yesterday. We are seeing Rheinmetall rebound somewhat so far in the first moments of trade, up more than 1%. But the rest of the defense sector does seem to be in the red. So maybe it was more about an earnings story dragging down Rheinmetall specifically, and it's rebounding today. But let's bring in our guest sitting here around the table. Joining us now is Beata Manthey, head of European equity strategy at Citi. Thank you for joining us on this Friday in August. What is your takeaway from European earnings season so far? We had a strong earnings season, especially when it comes to that mega cap tech in the U.S., but Europe seems to be holding in fairly well.
It is holding up fairly well. It was so far an okay season with some sectors underperforming, but with some really boosting their earnings and providing the beats. And that's, of course, financials and the bank sector, while the consumer discretionary has been a little bit subdued. But stepping back from just the reporting season and broadening it to the earnings story ahead for the European index, our view is that we are at a point of starting to see some upgrades. Why is that? Because we have this clearing event of tariffs behind us. 15% is not great, but it's better than 20% that our topped-down models were suggesting was already in the analyst forecasts. So better reporting season and actually a bit less of the burden from tariffs. So going ahead, I think, and our model suggests that it's going to be a bit more upbeat outlook for earnings, for European earnings.
Talk to us a little bit more about those upgrades you mentioned. Is that focused specifically on tariff-exposed sectors, or is it a broad upgrade because of just the tariff uncertainty kind of unleashing business investments?
So when you look at the sectors that have been downgraded the most, of course, these are the manufacturers, the dollar earners, exporters with the headwinds of tariffs. So that's autos, of course, that basic resources, energy has seen huge downgrades, tech, luxury goods, all of these. The only cyclical sector that has held up well enough in Europe is banks, and actually banks are still seeing the biggest upgrades in this reporting season, right? So that's our top pick in cyclicality in Europe, banks, but we also like some sectors that have been beaten up, like tech or healthcare, for example, that have this exposure and have seen a huge amount of downgrades.
I think everyone wants to close the conversation on tariffs. That's certainly the ambition for everybody. That being said, you said that it's behind us. Do you really believe that the tariff conversation in Europe is behind us? I think that the fear is that this is something that will reanimate every time there is a policy priority in the United States. And I understand it's difficult to price, but is it difficult to price and thus people just ignore it?
Very fair. It's not completely behind us, but at least the tariff announcement is behind us. And absolutely, the uncertainty is going to continue, right? You see what has happened to Switzerland, you've seen what has happened to gold. But the way I think about it for Europe is the more uncertainty from that front comes against Europe, the more Europe is getting its act together, right? So, and by that I mean the fiscal, especially out of Germany, that going forward, in our view, should outweigh these still some uncertainties that you're talking about.
And then something else that's also difficult to price, I'll put you on the spot for all the difficult things to price here, is this conversation that we're hearing we're going to have between Trump and Putin next week. I know it's very difficult to sort of expect a great deal from it. That being said, if it is a step in a sort of direction of détente, what does that mean for the picture in Europe? Could it be, bullish? Because there a positive story to tell there?
I think it should be really bullish, especially for the manufacturing and very energy-heavy sectors. So cost of energy in Europe for households and businesses is 2-3 times higher than it is in China or the US. Europe can't be competitive without lower energy prices. And what could this ceasefire bring is lower prices both in oil and natural gas. So we've made some calculations looking actually at the consumption of energy for last year and inputting the forecast from our commodity strategies for $60 oil and natural gas halving over time. That would result in up to 1% worth of GDP savings just on lower energy prices. This is a hidden stimulus for Europe on its own, right? So definitely bullish.
Well, speaking of the word stimulus, the counter argument to the case you're making there simply, and we're kind of already seeing it, is an unwind in some of these very lofty defense valuations, ultimately. If there is that thawing in the relationship or even an potential end to the conflict, does that undermine the need to ramp up defense at a time when you're already seeing a lot of fiscal authorities say, we made some promises, some very big ones, it's unclear if we'll execute on it. That's already been a worry that's baked into this market. Is that something where the geopolitical positives become market negatives?
Short term, perhaps, you see what is happening, but longer term, we don't think so, because the defense spend is for real and it is for a long time, right? It's not only about the Ukraine conflict; it's about Europe having its independence in security. So, our view is, of course, defense stocks have run its course and some stocks more than doubled this year. However, it's still a very small part of the market. So right now, market cap-wise, it makes up 5% of European market cap. Many European asset owners do not own it because of the ESG constraints. And these are changing, right? So our view is, as you have these pullbacks, you will start seeing different type of buyers that haven't had it in their portfolios emerging and buying on the dips. But one is defense and another one is the broader infrastructure spend, which I think it's more under-owned by the market. And of course, the Ukraine ceasefire could prop up this trade or baskets versus the defense spend.
Let's talk about another component that I know Valerie Tytel's very excited about, monetary policy. Specifically, one of the key bull cases for Europe was simply that while the Fed stays pat, the ECB can cut, the BOE can cut, and are planning to cut. And that is baked into the tailwind of the stock 600. Now that we're seeing potentially a more dovish tilt or expectation of a dovish tilt from the Federal Reserve, does that undermine that component of the bull case for Europe?
It depends. Ideally, you would like to see the ECB to keep cutting. However, they've already cut a lot, right? So everything depends on what the economy is going to do going forward. Is it going to be resilient? And from the current levels where we are quite subdued, it is plausible to see upsides into the next year, especially with the fiscal in Europe, right? Ideally, you would like the cuts. Most likely, we won't get as many as we expected before, but our economists at Citi actually think that the market is underpricing the potential. So we might have a few more than the market is pricing right now.
And Beata, when we talk about monetary policy, I think we need to talk about FX because the move in the euro has really shown up in a lot of earnings reports recently. And for what you just said, we could really see a divergence in monetary policy next year if the ECB is done cutting, but then the Fed really does pick up steam. And that is an argument for a weaker dollar and a stronger euro. Do you think that kind of theme will play into the fourth quarter, or the third quarter and the fourth quarter, in terms of a headwind for earnings?
So we've been already seeing this from the start of the year as headwind for this manufacturing exporters. But let's not forget that Europe, in terms of the equity markets, its exposure is 50-50. 50% is domestic, 50% is international. So that's how we are still positioned. And of course, when you come back to the stimulus and what it underpins, it is the domestic story, right? So I would be still backing this one, giving the FX headwinds. However, on the other hand, from the global investors' perspective, where it plays into diversification, because most of investors around the world, they'll be benchmarking, equity investors, I should add, they benchmark themselves in the US dollars, right? So the weakness of the dollar really undermines the performance of their US holdings. Therefore, you want to diversify to other parts of the world where the currency appreciation helps you.
All right, Beata Manthey, head of European equity strategy over at Citi, joining us around the table this Friday morning. We thank you so much. Let's hit a quick check on the core six, the heavyweights that, of course, move the stock 600. And when you're looking at how these are all outperforming, Novo Nordisk is a massive leader this morning, higher by 3.4%. And this is really the story that Ollie was pointing out earlier. Eli Lilly coming out yesterday, they actually had their kind of weight loss drug study, an 11% showing for that in terms of the weight loss reduction. I believe Novo Nordisk's numbers are about 14 or 15%. So that disappointment from the key competitor for Novo Nordisk, actually a bit of a tailwind when it comes to Novo Nordisk's numbers this morning, or at least share price this morning. When you look at the others, you are seeing a little bit of a reversal in the outperformance we saw yesterday. ASML, Schneider Electric were the key outperformers in yesterday's session. They're taking a back seat today. Let's get a check on some of the other individual stocks on the move. Luis Moon has that for us. Luis.
Hi, Kriti. So the first one we're looking at right now is GSK. They're up 1.5% almost. That's after they reached an agreement over their COVID jabs. They're set to get almost $400 million on the back of that. Moving on to insurers, we're starting with Munich Re. So they cut their part of their full year guidance down over 7% on the back of that news this morning into the red. And then also within the same sector in Germany, NN Group. They also had their results this morning. Taking a look at their shares, up 1.5%. So into the green this morning. That's after they beat estimates. So positive news on that front. And then turning to Novo, as you were just saying, they had news out overnight that is a bit of a boost to the stock this morning, but also raised to a hold this morning as well. So benefiting their stock up almost 3% into the green. So good news for Novo this morning. And then finally, ending on Lotus Bakeries, maker of Biscoff, has to say, I do like a bit of Biscoff. They're up almost over 7% this morning. That's after their first half revenue met estimates, so positive news on their results this morning.
All right, Luis Moon from our equities team, we thank you so much walking us through some of those early movers. Coming up on the program, we're going to get a little bit more analysis. Michael Masika, Bloomberg's EMEA's equity market senior strategist. We are going to talk through earnings season with him. That conversation next. This is Bloomberg.
Tariffs are always a bad deal for consumers. When you look at 15%, you can say 15% is better than the 30 that were announced, but it's worse than zero.
With the agreement with Europe, we see an additional 5%. That also we see it perhaps around the mid-double-digit mark in terms of impact for us for the rest of the fiscal year.
The indirect tariff guesstimate for this fiscal quarter is probably less pronounced than we thought last quarter.
I would be careful here because, of course, the indirect effects on the global and European economy are really hard to predict. So I wouldn't be overly optimistic. I wouldn't be overly nervous.
We will start to see customers actually understanding what they need to do now to adjust their supply chain to what is a structurally different trading environment.
Nations will just have to work with the United States and work with corporations to create change.
Of course, it's also clear that Europe and Germany have to focus on improving economic conditions. Only with stronger economic power we will have a better negotiation position at the table.
Some of the European companies' bosses we've spoken to on Bloomberg this week on the impact of U.S. tariffs. And it did stick out to me, guys, how many CEOs and CFOs wanted to tout how close they are to the administration, that they are in continued talks with Trump and his team. It seems to be like they know that's what investors want to hear, that they are in the president's ear.
And they're in the president's ear. They're offering investments. I thought the story of the week that I thought was really interesting was Tim Cook went to the White House and offered not only the investment promise, but a gold bar with a
gold bar from Utah.
A gold bar from Utah with, not tariff from Utah, but a little plaque as well. And I think it really speaks to your point, this kind of sensation that you are getting rewarded for that closeness, even if your supply chains are exposed or if your currency exposed.
Yeah, and I think also the Apple news yesterday about the pledge and really the kind of realisticness of all of these pledges that we're hearing from, all these companies around the world. What I find kind of worrying about this, and I don't want to oversell it, but we're in a point now, okay, every company is always going to massage their numbers. They're going to try to tell a more positive story. But we're in a moment now where basically open deceit is okay now because you have to pay to play with the Trump administration. And that is sort of something that we've come to accept for companies and having to, operate in the United States. That is something that is quite concerning.
Yes, promising the world to the U.S. president seems to be the tactic, whether that's a tech stock like Tim Cook or pledging investment as pharmaceuticals. But look, we've also heard those same kind of things from European defense, the nations themselves pledging that kind of defense money, pledging that NATO money, which many people are also raising an eyebrow to, thinking, well, once Trump's out of office, are they really still serious about that defense spending? So maybe a lot of eyebrows raised at the amount of money spent or promised to be spent. Let's bring in Michael Masika on this, Bloomberg's senior strategist for EMEA equity markets, macro trends and strategy. Thanks for joining us on this Friday in August. Give us a sense of how earnings season has been. What were the key surprises to you, someone who looks so closely at the equity market?
Well, the key surprise is that the earnings season was way better than people anticipated, to be honest. Even if it's like a mixed bag in Europe and like much stronger in the US, what we've seen is the bar was lowered like so much before the earnings season. We had like a salvo of earnings downgrades, especially in Europe, but also in the US, coming into the season because analysts were really scared about tariffs and the impact that they would have, the currency as well, especially in Europe. And at the end of the day, what we've seen were, like you said, CEOs saying, well, we're weathering the tariff impact. It's going to be fine. We're going to raise prices. We're going to change a bit of our supply chain. We're going to get through this without too much damage. And that's what we've seen. And as the earnings season was unfolding, the number of downgrades, of EPS downgrades, started to reduce. And now we're in the US, we're having upgrades already. And in Europe, we're very close to that point as well. So earning revisions are becoming positive. People are less scared about it. That doesn't mean the uncertainty is gone. Absolutely not, especially we know pharma is still a question mark. Switzerland is a question mark. There's still a lot of, potential upsets in the next few weeks. But overall, it's a pretty good surprise.
Yeah, and that's sort of the top line view. I'd like to get your side of perspective on kind of individual surprises, what stood out to you. I mean, for me and for the conversations we've had over the last couple of days, I think that the conversation with Mueller-Maersk and the shipping was one of the most interesting. This is the main policy plank for the Trump administration. You'd think a global trade war between the U.S. and the rest of the world would diminish their expectations. That is not what we saw. We did see shipments go down into the United States. We saw global trade elsewhere make up for that.
Yeah, that's the idea. I mean, if Trump wants a trade war with his trading partners, he might have it or might not have it, but it doesn't matter. The rest of the world still wants to trade. Europe wants to keep trading with China, and it's very important for a lot of sectors, especially the mining sectors, the oil sector, the industrial sector, and all of this is, it's like manifesting in these in the shipping and in the global trade, generally speaking, but also like even with tariffs, even with a little bit of trade war, even if with tensions. I mean, at the end of the day, the U.S. administration want to keep trading. Like they want reshoring, but they want to keep trading. And I think analysts, investors came to the conclusion: okay, this is not going to be a destruction of growth that we thought it would become, and that sentiment is gone. Like the sentiment that this would destroy U.S. growth, global growth, it's not. This is kind of gone now. People think it's going to be fine.
That's fascinating because I literally asked our guest yesterday, is everything fine? She was like, yeah, I kind of think it is. I think it's fascinating, though, as well, is because when we're talking about this reshoring argument or even the tariff kind of limited exposure argument, there was, at least in the first 6 months of the year, you saw small caps really become the outperformer on that trade. It feels now that large caps are perhaps getting rewarded even more because they have the liquidity to weather them as opposed to despite their exposure.
That's right. But again, we have what really happened during this year, actually, it's not just the earnings season, but there's now a lot of dislocation between Europe and the US. So, for example, in Europe, small caps are performing really, really well. They've started to really outperform large caps over the past few months, not in the US. The same way value stocks in Europe have been doing extremely well. They've been leading the market for the past 18 months in Europe, not in the US. And it's a very rare dislocation. If you look at the past 10, 15, even 20 years, that really rarely happen. So there's a shift. In the US, it's large caps only. Only large caps, only big tech. If you look at the S&P 500 now, this is everything that's carrying the market higher. The concentration is literally back on. The weight of tech in the S&P 500 is very close to what it was during the tech bubble. So we're getting to that point in the US. Where in Europe, it's completely different. It's the banks, it's the domestic economy, it's everything that is linked to stimulus, to investment from the state, from the private sector. We're talking defense, but we're talking infrastructure as well. And it's all this universe that is getting money, invested money, that is performing.
And Michael, I have to ask you about the next catalyst maybe for European equities, which is perhaps a ceasefire in the Russia-Ukraine war. What's the best trade?
Well, you have a lot of baskets with all the stocks geared to reconstructions. They've been underperforming for a while, and now they're starting to really pick up. We've seen it yesterday. It was like instant impact on steel makers, especially the ones that are exposed to Eastern Europe, banks, Eastern European banks, or European banks exposed to Eastern Europe. You have chemicals as well, which are really exposed to that. So all those sectors, they're getting traction because of this. And that might be the next trade. Infrastructure as well, obviously, because there's a lot to rebuild over there.
Well, Michael Masika, thank you so much. That's Bloomberg senior strategist here talking to us a little bit about what has been driving the conversation here in earnings season at the top level and into the sort of individuals, and ending there on the conversation about the next catalyst, potentially Russia, Ukraine. That is a conversation that we're going to continue into the next part of the show. We've seen the sort of vote from the oil market. Oil has come down over the last 5 days, down about 5%. Is this something that we can really sort of hang our hats on? As the Ukraine deadline for Putin arrives, we will talk to Tom Keating, director of RUSI, for Center for Finance and Security, to understand exactly what brought Putin to the table if he was there. Is it to do with this deficit? There's another story, the record deficit for Russia. All that next. This is Bloomberg. This is the opening trade. We are 30 minutes into Friday's session, the last session of the week. What are we seeing across the board? Overall, a sort of positive picture here in Europe. The Stoxx 600 up just a hair there, about almost 0.1%. DAX, the big loser today, down almost 1/5 of 1 percentage point. That is down to Munich Re, depends how you pronounce it, down about 7%. Rheinmetall on the upside there on the DAX. CAC, basically flat, up 0.1%, and the FTSE 100 after that Bank of England decision yesterday, virtually flat this morning. Kriti.
Yeah, drifting higher, but marginally, to your point. A lot of that might simply be because it's Friday, it's a summer Friday, it's an August summer Friday, it's an August summer Friday in Europe, and volume is down about 41%, which ordinarily means that things do kind of ultimately drift higher. And that's why you're seeing 375 stocks in the green. But there are a couple 52-week highs I want to draw your attention to, specifically when it comes to some of these numbers. I'm going to start with the right here. Unicredit higher by 1.2%, really just notching in those highs. We just had a conversation with Beata Manthey over at Citigroup saying they are one of not only the best performers, but one of the ones that have the consensus when it comes to bullish sentiment on the street. NN Group is another higher by about 0.7%. And RBI, which is actually the ticker for Raiffeisen Group, and that is one of the largest foreign-owned banks in Ukraine and Russia. So this looks like a trade at least pricing in some of those potential ceasefire talks, or at least a negotiation to make things easier to that conflict, higher by 2.4%. It is not all green on the screen, though. There are a couple lows I want to bring your attention to as well. Wolters Kluwer, down about 2.5%. And Croda International taking a hit this morning as well, Val.
Well, Kriti, here's what else you need to know this morning. Bloomberg has learned that Meta has selected PIMCO and Blue Owl Capital to lead a $29 billion financing round for its data center expansion in rural Louisiana. Sources say PIMCO is set to lead the $26 billion debt portion of financing, while Blue Owl is providing $3 billion in equity. And President Trump says he's chosen Council of Economic Advisors Chairman Stephen Miran to serve as the Federal Reserve Governor. The appointment still needs to be confirmed by the Senate, but would add a voice who's echoed Trump's calls for urgent rate cuts. Miran will finish the rest of current Fed Governor Adriana Kugler's term, which ends in January. And finally, the U.S. has reported that it has put tariffs on imports of 1 kilogram gold bars, dealing a fresh trade blow to the precious metals hub of Switzerland. According to the FT, it was detailed in a July 31st ruling from the U.S. Customs and Border Protection Agency. Gold futures in New York surged to a record high on the report.
It's a fascinating one as we look at kind of the dynamics in Switzerland as well, an economy that has largely been used when it comes to things like hedging. You see that in the gold prices, you see that in the Swiss franc, for example, largely benefiting from a defensive trade, whether it comes to monetary policy, whether it comes to uncertainty from the United States, or ultimately the geopolitics as well. And that's, of course, something that we're kind of bracing for when it comes to some of the conversations we're expected to have between Donald Trump and Vladimir Putin.
Yeah, very difficult conversations indeed. And sort of some of the things that very muted expectations. And I think it's worth sort of going through a little bit of what we've been seeing from the conversations, what we're going to anticipate. We're going to talk first also, though, about the Swiss economy. I want to come back to this because I think that we talk about gold bars, we talk about watches. These are sort of the things that are, on top of the pharmaceutical sector, the main issues for Switzerland, but also thinking about sort of people at home in the United States, what it's going to actually hit. I think about Nespresso, and I look at Nestle down almost 20% the year. All of the capsules are produced in Switzerland domestically and exported out. All of them.
Oh, my.
All 3 of the sites.
That's adding to the pressure on coffee. We know the coffee prices, at least the commodity, has surged. So that might anger some people who are big coffee drinkers of Nespresso. Is that you, Kriti?
I miss, yes, except there are no Nespresso machines, of course, in this building. But I am a Nespresso loyalist, I think. The flavor, anything with flavored coffees, a million options that make it very hard to decide.
Coffee ice cream on the top of the list there?
Haagen-Dazs, coffee ice cream, folks. I mean, if you need sweets and ice cream recommendations, I'm your gal.
But it is interesting that it does seem to be that the Trump administration just keeps putting the pressure on Switzerland. And I don't know if they just sense some weakness. The government hasn't necessarily put together a response package. They haven't retaliated, which you could argue is a good thing for the Trump administration. But it does seem to be interesting that the pressure on Switzerland has increased substantially over the last few days.
And I think that was one of the major tariff conversations of this week. And one of the major tariff deadlines of this week was secondary sanctions on the buyers of Russian crude oil. We went from a conversation about the United States imposing bone-crushing sanctions on Russia to a summit between Vladimir Putin and Donald Trump that is expected next week. I'll give you just what we know so far about this conversation. The when, it'll happen over the next few days. The where, we do not know where it is, but we know that they have decided on a location. The question is also fundamentally the who. We know that it will be between Trump and Putin. There is very likely to be an attachment to that of Trump and Zelensky. Will there be a trilateral meeting between Putin, Trump, and Zelensky? That is what the United States has been pushing forward. And when we think about these conversations and how difficult they are going to be, there are red lines all over the place for everybody's opening positions. The Ukrainians do not want to give any territory away. They have talked about full withdrawal from Russia. They have talked about Russia paying reparations for all of the destruction done in Ukraine. Russia is looking to lift the sanctions. They want a total demilitarization of Ukraine. They want a guarantee to never join NATO. And the United States is really pushing that idea of a ceasefire. They are putting on the table potentially recognizing Crimea and talking about potential distributions of land control within Russia. So that is kind of setting up the conversation. We need to put a little bit more clarity into what we can expect from these talks. Let's do that now with Tom Keating, who's the director of RUSI's Center for Finance and Security. Tom, thanks so much for joining us this morning in, admittedly a situation where we, have a lot of ambiguity. How did we get from bone-crushing sanctions today to a person-in-person meeting between Donald Trump and Vladimir Putin?
Well, thanks for having me. I mean, if there's one thing we know about Donald Trump is he has great belief in his ability to dialogue with people and persuade them to change their minds or to persuade them to trade. And so obviously over the last 6 months, he's tried to do that with Vladimir Putin down the phone. He's expressed considerable disappointment at the lack of progress, nice conversations, but not going anywhere. And indeed, Melania pointing out to him that Russia is still bombarding Ukraine every night. But now we seem to have got to a point where perhaps Vladimir Putin is starting to see some writing on the wall. And I think this targeting of the key funding mechanism of the Russian military, which is the sale of oil, targeting India, we can talk about how that's going, but targeting India, one of the two biggest buyers still of Russian oil, is perhaps making the Kremlin think twice.
So you think that this is really down to the secondary sanctions? No one has really experimented with something of that magnitude for Russia. So you think that that is what's bringing him to the table? If he gets to that table, what is your expectation of what can actually be achieved next week? Are we stepping in the right direction? I mean, it's hard for me to imagine a situation in which Trump puts himself in a room with Putin and then has nothing to show for it afterwards.
Indeed, and I think that's a risk. Of course, on the graphic you showed there, the one group that were not represented or aren't anticipated to be represented in any conversation is the European Union, or Europe more broadly. So I think the concern is that Trump may give away things that it doesn't really bother him, he doesn't care about, and that might include risks to European security, and indeed not taking into consideration the red lines that you showed there that President Zelensky and the Ukrainians have. So I think it's a risky position that Trump is taking because, as you rightly say, he's not going to fly all the way to the UAE, Turkey, Saudi, wherever it might be, have a conversation and then say, okay, it was a nice conversation, but we haven't achieved anything. So I think that's really going to be what we need to watch out for. What does Steve Witkoff tell us from his meetings that he had in Moscow this week? I'm concerned for the Ukrainians in the current situation.
Tom, I want to ask you a question about something that was reported by Politico, that the White House was saying that Putin must meet with Zelensky before Trump does. Do you think that's a realistic expectation? And is that something that perhaps is going to get this situation calmed down before Trump even enters the negotiations and perhaps a trilateral meeting?
So I think the first thing to say is let's wait and see if Donald Trump actually gets on Air Force One and flies east for these meetings. And the Zelensky possibility is perhaps a blocker opportunity. In other words, if you won't meet Zelensky, then I won't fly to come and meet you, Vladimir Putin. So perhaps Trump has finally understood that whatever deal is done needs to respect the Ukrainians. But as I say, my concern would be that in his desire to do a deal, and as we know, that is what Trump loves more than anything else, in his desire to do a deal, he may well throw Ukrainians under the bus.
Well, I guess to that comment of yours right there, what do you think of the relationship currently between the U.S. president and Zelensky? Is that something that has improved lately? Is that something that can help him in these negotiations? How are you viewing the state of the relationship between Ukraine and Russia? Sorry, Ukraine and the U.S.
Yes, I think unlike many European leaders who have been obsequious towards Trump, but that's kind of what you need, I think Vladimir Zelensky took a while to kind of switch track and to realize that this is the way to operate. It would seem as though that relationship has improved dramatically. Obviously, the US is leaning in more to the sanctions topic, the tariff topic, in order to support Ukraine. It has continued to provide weapons. So the situation is way better than that disastrous meeting in the Oval Office back in February. So I think Zelensky has tapped into Trump. They're probably more on the same wavelength now. Zelensky has good advisors around him who are also, I think, playing that game. So we're in a far better position from a Ukrainian perspective than we were 4 or 5 months ago. But at the end of the day, there are still nightly bombardments of Kyiv and other cities in Ukraine, and that needs to stop before there can be any realistic consideration of discussions.
Tom, how do you think this is being received by some of the folks perhaps powering Putin's war machine? We're thinking about India in terms of their oil purchases, which Ollie had mentioned earlier. We're talking about China, of course, even the likes of Hungary or Slovakia, for example. How do you think this development is being received?
Look, I mean, ultimately, I don't think any of those countries you mentioned wants a war to be happening in Ukraine. It's not in the interest of China. It's not in the interest of any European country, wherever they might sit within the European Union. But the sanctions that we've been focused on for the last 3.5 years are not universal. They are European and US sanctions, G7 sanctions. And so, the likes of India have been within their rights to choose to buy oil from Russia. They have or have not been buying it within the oil price cap, but they've had tremendous leverage over Russia in that trade because Russia has to sell its oil in order to survive as an economy. So they, I think, would much rather there were peace than not peace. What they have a problem with is being dragged into the situation with things like this threat of now in under 21 days tariffs for making a sovereign choice to buy Russian oil, which is entirely within their gift.
But Tom, talk to us then about perhaps just how much cash Vladimir Putin has left. We have geopolitical experts on that come and talk about the fact that potentially Vladimir Putin is running out of cash. The economy is under a lot of strain. How much kind of willpower does he have, not necessarily in terms of fighting the war, but actually keeping his country running with this kind of finances?
Well, he has more road than if he were a kind of Western liberal democracy. I mean, if you look at the state of the finances of kind of individuals in a democratic society, that wouldn't be tolerated. I mean, I think everyone always felt that he had kind of 3 to 5 years of financial firepower to use to fight this war. We're now 3.5 years into that period. But the critical element here is as long as countries continue to buy Russian oil in the kind of tens of billions of dollars per year, as both India and China are doing, then he can eke out his financial situation and he can continue to prosecute his war, even if that means he neglects other parts of his economy. Fundamentally, this is now a war economy in Russia. People are working on the war in production or indeed in fighting in Ukraine. And so I think he's got a lot more road to go than we would like. We can reduce that road by encouraging the likes of India to source their oil from elsewhere in the world, perhaps the United States, rather than funding the Kremlin's war in Ukraine.
Well, Tom Keating, who's the director of RUSI's Center for Finance and Security, we thank you this morning for your insight. And if the hope is for a détente between Russia and Ukraine, there is no such hope between Gaza and Israel. The Shekel is falling this morning after Israel's Security Cabinet approved Benjamin Netanyahu, the Prime Minister's plan to take full control of Gaza City. The move is seen as a final push to topple Hamas and end a 22 months of fighting in Gaza. Let's go to Tel Aviv now and speak to the Israeli bureau chief, Ethan Bronner. Ethan, it's hard to know really where to begin in this conversation, potentially with kind of the reaction for what Israelis. There's a real division about this decision. And, of course, the international community. Take us through the latest and what the reaction is.
Sure. I mean, abroad, people are horrified at this, at the idea of this happening. There's no question about that. The Dutch have already announced an end to some export licenses. The British foreign minister, or prime minister, forgive me, has spoken out against it. The only country abroad that really does want it is the United States, or at least is willing to see it, and that's President Trump, who has made clear to Prime Minister Netanyahu and to those around him that he is willing to see this attempt to destroy Hamas in this last push, which could take some months. It's not going to be easy. And inside of Israel, as you note, there's also enormous concern for the 50 remaining hostages and for the soldiers, the tens of thousands of soldiers who are going to go in, as well as, of course, the concern about the civilian deaths and destruction and hunger that are going to follow. Now, one other thing they've decided to do with the help of the United States is to increase, they say vastly, the amount of humanitarian aid that will go to those who will be displaced in this move.
Well, Ethan, just walk us through a little bit more of the details of this actual plan. In theory, who would run Gaza?
Well, this plan is a whole bunch of things that are going to happen before anyone is going to run Gaza. But the prime minister has repeatedly said that his plan, once Hamas is destroyed and removed from office, from power, and disarmed, is that there will be some kind of Arab and Palestinian structure running Gaza, but they will not be associated with Hamas or with the current Palestinian Authority. That is his plan.
All right, Bloomberg's Israel Bureau Chief Ethan Bronner joining us for that crucial context. We thank you so much for your time. More ahead. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We're 50 minutes in today's European session. We are fairly mixed when it comes to the European equity picture. Eurostoxx 600, the broad European benchmark, is in the green, up 0.1%, but the DAX is underperforming this morning. That due to results from the insurance giant Munich Re dragging down the index. It's down 0.3%. Now, regulations since the global financial crisis may have added as many as 51 million hours of annual financial paperwork for Wall Street. The increased buildup has been called a waste of time by JP Morgan CEO Jamie Dimon. The estimate comes from new analysis by Bloomberg that is the subject of today's Big Take. Let's get more from Bloomberg's Tom Metcalf. Tom, has more of the attention turned to President Trump's deregulation agenda, and how risky is that likely to be in the world of finance?
Yeah, look, it's certainly one of the kind of the third leg of what they're trying to do, and I think the question of risk is a fascinating one, which we explore in the Big Take, because it's so hard to know, right? There's unintended consequences, and of course you've seen plenty of examples of regulations have potentially staved off huge costs. But as you can tell from certainly Jamie Dimon's comments, generally the banking industry feels the regulations have gone too far, and they're certainly pushing for a hefty rollback. And that's why this story is so interesting, because often this debate is fairly diffuse and it's just kind of based on feel. And what Laura Noonan did was go out there and effectively quantify all these regulations. You're looking at 51 million hours of additional work, and I think that will help kind of couch the debate in terms of that's the added workload. Is it worth it, basically?
What's the point of it? Like, what's the point? What's the goal of these new moves?
From the Trump administration, in terms of, what they've come out and said is, look, for every new rule you want to put in, we'll take out 10. I mean, that's kind of classic Trump administration move, very dramatic. How practical that is, I don't know. I mean, it's the question of, are they looking to completely gut these things, or is it basically a rollback? They feel things have gone too far. I think the banking industry, wants something more measured in terms of let's roll back some of this without completely throwing everything out. But in terms of, activity so far, some regulators have already been effectively completely denuded. So it'll be interesting to see as the administration continues just how far they go. And as I say, for me, it's those unintended consequences. Sounds great on paper, sounds great to your base, but, will they be so happy if a regulator could have stepped in and saved a bunch of money, but didn't have the resources to do that?
And Tom, I think this is a great piece on the terminal, because one of the reasons why I left trading, why I left the trading floor, was frankly because regulation, the time spent in my hours of day were just swamped by the amount of paperwork I had to fill out for trade. So I understand and have sympathy for the amount that is piled up, 51 million hours of work on regulation.
Is my takeaway that bankers don't like being regulated?
Oh, of course.
Okay. Well, thanks very much, Tom Metcalf, for a look at the Big Take and all of the research and light that's been shed on that issue. Thank you very much this morning. Let's bring it on to what we have to watch for the rest of the day. Of course, after that tightly balanced, what was it? What did they say about the Bank of England decision? It was
finely balanced, two rounds of votes.
That's right, 2 rounds of votes. We'll get a little bit more clarity on some of the thinking there from the BOE chief economist Hugh Pill, who's speaking a little bit later today following that interest rate decision. In Canada, we're going to get those unemployment numbers. We're going to hear from a number of Fed speakers, and we're also going to get the Chinese PPI, CPI data. That is the big takeaway for Valerie Tytel, in addition to hearing from the Federal Reserve's dove-in-chief.
She might have a spicy speech on her hands here. She was the dissenter with Governor Chris Waller, who's now been talked about as being Fed chair. We've had this weak payroll report. Maybe she comes out with even more comments backing her view that rates should be much lower. But Bloomberg also spoke to the new temporary Fed Governor, Stephen Miran, yesterday before the announcement that he would take Adriana Kugler's place. Take a listen to his view on inflation.
You're right. There's been a lot of conversation about this subject, and I think that a few things are worth mentioning. One, we ran this experiment in 2018, 2019. We saw zero macroeconomically significant evidence of tariff-driven inflation then. Two, we've been running higher tariffs in this administration since the very first day, since January 20th. We've now got several months of data, and again, there's just zero macroeconomically significant evidence of price pressures from tariffs. Three, the overall policy mix is extremely disinflationary.
Look, that is a key view from Stephen Miran that's been echoed by Governor Chris Waller, this idea that tariffs don't cause inflation. And Miran saying there that if you take Trump's policies as a whole, they are deflationary, and that merits rates not as high as where they are now.
Yeah, I liked tariff derangement syndrome as a new one to sort of watch for and think about in terms of the sort of methodology and the theory behind tariffs. But this is really an important conversation going forward. I think what's interesting about it is that, you know, with all of this tariff sort of conversation that Trump has brought forward, you know, there's a lot of debate because no one really knows what the impact is going to be. And that is, I think, also why people have such fear, is that it's a very large experiment with the biggest economy in the world.
And the other thing that we need to mention about Stephen Miran is he did co-author a paper that was highly critical of how the Fed works. He wants a smaller Fed. He wants more oversight. He wants Congress more involved. So that's another, I guess, angle that perhaps this appointment to Adriana Kugler's seat could mean.
Potential appointment, and of course wait for that Senate confirmation as well, which is a key piece to all of this. We'll see if Donald Trump changes his mind between now and then. Of course, that appointment only until January, so it's going to be something we keep our eye on. Let's go to the fun stuff that I promise you is outside of the Federal Reserve's remit. We do have a weekender. We are getting excited about a couple of things on here. All about the NFL preseason, week one, top of the agenda for him, of course. But then, of course, we have the Edinburgh Fringe continuing. For me, it's the Zurich Street Parade. I didn't even know it was on this weekend. I went accidentally last year and found it to be a very, very fun time. So highly recommend if you are, of course, in Zurich. Then a couple of other kind of sporty things happening.
Yeah, 1 million people on the streets of Zurich. What could go wrong?
There you go.
Yeah, suffering from tariffs and other things. Yeah, I mean the NFL preseason. I mean I'm reliably informed by our producer Evander Thompson that the switch from NFL viewing of Redzone to ESPN. Everybody hates it. Apparently, everybody hates it.
Oh, gosh. Well, I mean, now you have to have Disney Plus to watch football. It just adds another $30 a month to your final bill.
Yeah.
Doesn't seem right.
No, it feels like it's something on linear cable television. Yeah.
This is where you got to get your daughter to get one of those student discounts and see if there's some sort of discount there. Lots going up happening on the weekend. We, of course, will have it all covered. You can catch it on the Bloomberg Weekend newsletter. A collection of interviews, ideas, stories to explore the fascinating places where finance, life, and culture meet. Lots going on. That does it for the opening trade. Have a good weekend. This is Bloomberg.